Hi, everyone. I'm Doug Alsdorf. Let's talk some more about the fear of missing out. We're going to review two stocks in this presentation and ask ourselves, should I sell this or should I keep it? And after watching this short 4-minute video, please watch the videos and then read the PDF that are associated with Chapter 10. And I'll put a link at the end of this video to Chapter 10. So here is the stock I'm talking about, one of them. The second one will come up in the next couple of slides. So it's the blue line that you see in through here. And as always, when given a plot, always check out the axes. So we're going from January 2000 to over here on the far right to January of 2010. And the y-axis is in thousands of dollars over there. And this is a $10,000 investment in this blue stock during these 10 years produces $77,000. We'd actually be pretty happy about that because this is the lost decade. And in all these plots I'm going to show you, the red line is VFINX, which is Vanguard's mutual fund that follows the S&P 500. And we see this was the lost decade, this entire decade when $10,000 didn't even make any money at all. So we'd be really super happy with this $77,000 gain in this one individual stock. Now, I'm not telling you who it is, because if I did, you know exactly what to do. But let's ask the question. It's $77,000. Here it's January of 2010. We've just come out of the Great Recession. Not fully out of it, but it looks like we're going to recover. So what do we do? Do we sell this counter blessing, so to speak, and switch over to buying S&P 500? Or do we keep this and say, nah, it's going to ride back up just like it did before? What do we do? Oh boy, it collapsed. It completely collapsed. Had we kept our money in, now we go from January 2010 all the way to mid 2025. Had we kept that blue stock, and as it turns out, it's BlackBerry. It was the cell phone to have back in the 2000 decade, that first decade. It was the cell phone, number one cell phone to have, and it completely tanked thereafter. And you can read the book to learn more about that. Instead, over here, we see this great bull market that the S&P 500, and indeed the overall investing markets in the U.S. have gone through. $10,000 became $70,000. Oh, yeah. So that really is heart-wrenching. All right. So here's our second chance. Now it's January of 2011 over here. We've got a different stock in blue, and we go over here to January 2019. That stock is up to making $100,000. Now, even though we've had a great bull market during this time, the red line doesn't show that very well because we've had this exceptional gain in this blue line in through there. But we might have been a little grumpy for a little while with our blue line because that stock, because for these several years in through here, it's actually doing less than the overall market. But here in 2016, it takes off. But by mid 2019, we've lost half our value. We're down to 98,000, still feeling pretty good about that gain. But man, losing $100,000 in just a few months would be really heart-wrenching. And you'd probably just want to push the sell button and be happy you pushed the sell button, got your money, did way better than what you could have done in the S&P 500, and you would have thought, yeah, I've made the right choice until you see this. This now goes from January 2019 over here on the left to mid 2025 over here on the right. This is NVIDIA. NVIDIA, the stock we've all heard about, right? It recovered and came roaring back. A $10,000 investment would be $400,000. This $98,000 investment, had we just let it ride, we'd have nearly $4 million. That's what the fear of missing out looks like. It drives us to do things that are emotional decisions, not actual investing decisions. This is all emotional ride that we've taken in through here. And I want you to spend some time in the book and in those other videos to learn how emotions impact our decision making and tend to push us away from the actual ideas of investing.